Ladies and gentlemen, good day and welcome to the Apollo Pipes Limited Q4 FY24 conference call hosted by Equirus Securities. As a reminder, all participant lines will be in the listen-only mode and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during the conference call, please signal an operator by pressing star and then 0 on your touchtone phone. Please note that this conference is being recorded. I now hand the conference over to Mr. Aman Agarwal from Equirus Securities. Thank you and over to you.
Thank you, Myron. Good morning, everyone. On behalf of Equirus Securities, I welcome you all to the Apollo Pipes Q4 FY24 and full year FY24 earnings conference call. From management side, we have with us Mr. Samir Gupta, Chairman and Managing Director, Mr. Arun Agarwal, Joint Managing Director, Mr. Ajay Kumar Jain, the Chief Financial Officer, and Mr. Anup Gupta, Group Chief Strategy Officer. I'll straight away hand over the call to management of Apollo Pipes for their opening comments. Over to you, Samir, sir.
Thank you. Good morning, everyone, and thank you for joining us on our full year FY24 earnings call to discuss the operating and financial performance. It was an exciting year for Apollo Pipes. In a way, we got a direction to double our capacity by FY26, plus we added 2 super value-added products in our portfolio, which is PVC-O pipes and blue PVC window profile. On organic front, we continued with 20% plus sales volume CAGR for FY24. As we went aggressive from beginning to expand our capacity, we could get hold of one of the leading pipe brands in West India, Kisan Moldings, at a price which we believe is very reasonable. An investment of rupees 120 crores straight away gave us footprint in West India with a capacity of 60,000 tons and potential revenue of 800 crores in 3 years. We kick-started our Greenfield Varanasi expansion with a total capex outlay of rupees 120 crores, which will add 30,000 tons to our overall capacity. With this plant, we will have a pan-India presence. As we are aggressive in our sales strategy, we are keeping EBITDA margin targets around 10% so as to keep gaining market share. With almost 286,000 tons capacity becoming live in next 18 months, we have a stage set for 25% sales volume CAGR for next 3 to 4 years. We spent rupees 135 crores in capex in FY24 and invested rupees 120 crores in Kisan acquisition. We will spend further 200 crores in FY25 and rupees 60 crores in FY26. I am glad to share that our balance sheet remains debt-free despite such commitments. Our finance and sales team have worked wonders to improve working capital cycle to 23 days. So our operating cash flow to EBITDA improved to 65% from 40% levels in the past. We expect this to sustain going forward. As far as Q4 FY24 is concerned, the performance was slightly below our own expectations, mainly due to decline in project sales. Our home construction segment increased 15% on YOY basis. We look forward to achieve revenue growth of 25 to 30% CAGR in next 4 years. We are also confident of hitting 25 to 30% of ROC despite these proposed investments supported by working capital efficiencies. This is from our side. Now we are glad to take questions. Thank you.
Thank you. We will now begin the question and answer session. Anyone who wishes to ask a question may press star and 1 on their touchtone telephone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we'll wait for a moment while the question queue assembles. We have the first question from the line of Pujan Shah from Molecule Ventures. Please go ahead.
Hi, sir. Am I audible?
Yes, you are loud and clear. Please go ahead.
Yes. Okay. So my first question would be on PVC-O pipes. As you have said that we have launched this new product, I just wanted to know, very few companies are making this product and being expertise in this product. So why we have selected this product, and what we envision for this product, and how potential the market size would be?
So this product goes into water supply pipelines, and as of now, only 7 manufacturers are in the country are manufacturing it, and there is a good demand for this sector, and this is a replacement of ductile iron pipes.
Replacement of ductile iron pipes.
Correct.
Yes. Okay. So just wanted to know more about it. So what could be the difference between the price of the ductile iron and the PVC or this PVC pipes?
Come again?
So just wanted to understand the difference between the pricing of the PVC prices and the ductile iron prices.
So look, as far as exact pricing are concerned, this is a price sensitive information, and this is related with business. Yes, there is a substantial price difference, that much we can say.
Okay.
Yeah.
So potentially, just wanted to know if we are focusing on this product, how potential we are trying to capture in terms of revenue, and what could be the EBITDA potential for this product?
So EBITDA potential should be somewhere around 25%, and this is not a very high volume product. So it's a low volume product. So top line should be with all the lines while running, the top line should be somewhere around 120-125 crores.
And this would be achievable in FY25 or FY26?
FY26.
FY26. Okay.
Full all the lines running will be FY26. We have one line running as of.
Okay. And sir, my next question would be on the Kisan molding. As we have said in the PPT that we are targeting a revenue of 900 crores. So just wanted to know how we are targeting and what are the plans we are envisioning for this target, and how will potentially grow towards it.
So Gunjan, if you look at Kisan Moldings, the current capacity of that company is around 60,000 tons, okay, and at current PVC prices, it can generate that kind of revenue, 800-900 crores, the number which we gave. Okay, it is just that for last 4-5 years, the company was not running to its full utilization because of the working capital constraints and all the long-term loans which went bad, NPAs, etc. with the banks. So company was struggling on that account. When we acquired the company, we cleared all the loans. Right now, there is a clean slate for the company to utilize its capacity of 60,000 tons. In terms of the market positioning, the brand positioning, the SKU range, the quality of plant and machinery, we found everything convincing that if given the proper platform, this brand can generate that kind of revenue. At peak, it did achieve 500-600 crore kind of revenue, right? And that was like 3-4 years back. And of course, the strength what that brand carries in the Western Indian markets, with support from a group like Apollo, we were highly convinced that this is going to get achieved over the next 2 to 3 years.
Okay, got it, sir. Thank you so much. I will join back in the call.
And just to add on your question of first question of that why we got into this OPVC space. See, I mean, Apollo being the 6th largest PVC company, we are following the trends, the new trends which the industry is following, right? Which the industry is coming up with. So we found this opportunity in OPVC segment, which is replacement of ductile iron pipes. This was a theme that the PVC industry emerged in India with the conversion of iron pipes, steel pipes, right? So our balance sheet size gave us the opportunity to invest that much of capital into a new technology, right? We took that I would say calculative risk, right? And based on the feedback what we are getting from the potential clients, so we are very excited with this new product line. And yes, as a group, it's our philosophy to start slow, right? But once we get convinced, once we taste the success, then we will go super aggressive in putting up new lines. So right now, what we can say is that the investment which we put in this line, in this product is with a calculative risk, so that the ramp up, even if it takes time, it doesn't drag on our balance sheet or cash flows. But the good news is that the feedback, initial feedback, has been pretty solid from the potential clients, and we are already looking to ramp up this business with addition of more lines over the next 2 to 3 years.
Right, got it, sir. Just wanted to know a quick question on what size of investment we have done in PVC pipe.
So if you see, like, we have added 2 new products to our portfolio. One is OPVC, and second is a window profile, which is into home improvement segment. Put together, in these 2 products, we are going to invest between 150 to 200 crores in next 1.5 years.
Okay, and capacity, if you can give any idea on capacity?
Capacity also, that is in our presentation, which we uploaded on the stock exchanges.
Okay.
Put together, we are adding 11,500 tons for these 2 new products.
Okay, got it. Thank you, sir.
Thank you. We have the next question on the line of Janish Karia from Antique Stock Broking. Please go ahead.
Yes, thank you for the opportunity.
Janish, your audio is not very clear. Request you to kindly go off the speakerphone and use the handset.
Is this better now?
It's still pretty feeble.
Just a second. I hope this is better now.
This is better, yes. Thank you.
Yeah. So, firstly, the question is on Kisan Moldings. The current 60,000 tons capacity, what would be the current utilization level? Where do we see it in the next 2 to 3 years? And with the 30 crore infusion that we are doing for capacity enhancements and improvements, what will be the potential capacity 2 to 3 years down the line for Kisan?
So if you look at the current run rate, it is around 25,000 tons, okay, March 24, which they closed. Our target for FY25 this year is around 35 to 40,000 tons, and then take it up to around 55, 60,000 tons by FY26, right? And then there will be minor capacity additions, right? Processes improvement, lines improvement, which may require 30-40 crores of investment, but that will come from the internal cash flows which the company, which the business will start generating now onwards.
Okay, so do we see a 10-15,000 tons capacity addition with that capex in Kisan?
Yeah, so target is to take capacity, which is right now 60,000 tons to 80,000 tons by March 27.
Okay, great. So secondly is on the tax for Kisan. So what is the tax status currently? Will it be a tax paying entity in the next 2 years with the profits flowing in? And what is the EBITDA target for the Kisan entity? I understand we have given a 10% guidance till FY27, but for the next 2 years, any clarity?
So regarding tax outgo, at least for the next 3 years, we don't see any cash outgo as of now as per our calculations. There are, say, brought forward losses and all. Number 2, regarding the EBITDA target, obviously we expect by late of, say, Q4, Q3 of 26, we should be generating 10% plus EBITDA in the company.
Okay, great. So next is on the working capital days for Kisan. So as I see in FY24, the inventory days were sharply down, but normally the Kisan as an entity used to keep 100-110 days of inventory and higher working capital. So do we plan to streamline it in line with Apollo in FY25 itself, or it will happen over a period of time?
It will happen over a period of time. Yes, you are right that they used to carry a higher inventory, but with the higher sales, obviously the number of the inventory or the working capital cycle will come down.
So any
it will be a gradual process, not any event like, yeah.
Any broader guidance you would like to give?
Yeah, so look, going forward by FY26 end, I think we should be, the working NWC should be less than 60 days.
Great. So next is on the Apollo entity level. What is the current mix of agri, non-agri products?
So the housing plumbing segment accounts for around 55% and 45% is agri.
Okay. And sir, just one thing, in opening remarks, we had mentioned that the FY24 volume performance was below our expectation because of lower project sales. So if that's the case, that the commentary of other pipe players was not in line with this, not in the similar lines. So what are we doing separately or differently, or which region was impacted because of low project sales? Any color on that front?
No, so it was only Q4 of FY24 which was soft, okay, not full FY24. In Q4 FY24, the project sales, not in the building material segment, but in the agri and water transportation segment, where the sales were down, not in the building material project sales.
Yeah, that's helpful. So just last one bookkeeping question. What is the plant-wise capacity? If you can just provide in FY24, that would be helpful.
So see, FY24, the total capacity, including Kisan, for the company was around 216,000 tons.
Yeah, if you could just break it up into Dadri plant, the Raipur plant, and Bangalore plant, if possible. Hello.
Can the management hear us? This is the operator. Can the management hear us? Ladies and gentlemen, please stay connected as we reconnect the management. Ladies and gentlemen, we have the management back again. So you may go ahead.
Yeah, so I just wanted if you could just break down the capacity between the Dadri plant, Bangalore plant, and Raipur plant.
So this, of course, because of data sensitivity, we are not giving exact numbers, but what I can tell you is that the total capacity was 216,000 tons, right, as at March 24. Kisan was 60,000 ton out of this, right. Now, out of 216, 45% is in North, okay, around 100,000 tons is in North, and balance is in South, which is, say, 40,000 tons, and rest in Ahmedabad and Raipur.
Sure. Thank you. That's helpful. Thank you so much and all the best.
Thank you. We have the next question from the line of Ashish from InvestQ. Please go ahead.
Yeah, hi. Few questions. I mean, looking at the number delivery from maybe the leader that we saw and our numbers in terms of sales growth, clearly for the past 18 months, we've had challenges on sales growth despite having capacities. There has been a kind of a struggle between volumes and margins. So could you explain, I mean, what challenges are we facing, fierce competition, difficulties in getting things through in terms of delivery of volume growth? So if some qualitative aspects can be shared, I mean, we'll have a better picture of how things are shaping further.
See, barring second half of FY24, okay, the performance has been pretty on the expected lines. Okay, if we look at the business plan, what we built, okay, 2 years back. So from 45,000 tons, we came to 65,000 tons, and from there around 80,000 tons for the full year. Okay, and this is what we have been guiding for, around 25% volume growth. right? And FY24 we could do 22%, right? So yes, there is a slight miss because of the second half, which was weaker for us. And the reason for that was, like we said, that the project sales in the agri side, that's where the traction was pretty solid in the last 2 years. But then a lot of competition comes in, right? And then people go aggressively bid at low prices, and they also stuck their working capital. So as a company, we always have this clarity in our minds that we don't want to deploy too much capital for the government-based projects, right? And anyways, they are low margin. So we just took a backseat there, okay, and that's why there's 3-4% slip in the overall growth for the full year. As far as the trade sales is concerned, or the home improvement segment is concerned, the numbers in terms of distributor addition, SKU addition, and ramp up, we are pretty much on track. And margins, yes, we have been pretty vocal about it, that as management we took we adopted this strategy to go highly aggressive on sales, right, and slightly compromise on the margins, which we were in 12-13% at EBITDA level range. Now we are at 10% EBITDA level range, because as you can see, we have invested heavily into building capacities in last 2 years, and the amount of capex what we are going to incur over the next 2 years, right? Almost 500 crore capex plan, which we initiated in the beginning of FY24. So idea is to build capacities, right, which come with a lot of upfront fixed costs, right? So that's why the margins will appear low optically, right? And then when you gain market share, you compete against strong peers, okay? So you need to offer more sweeteners to your clients, which we are doing. All in all, what we believe is that we are in the super expansion phase, right? For our company, our gross block, which used to be like 250-300 crores 2-3 years back, it will be almost 800 crores in next 2 years. Okay, so first is to build such capacity, right, and then spend on brand, right, which could consume this much of capacity in terms of market pull, right? So that's what we are doing. We appointed Amitabh Bachchan as our brand ambassador last year as well. Okay. And yes, at 10% EBITDA margin, idea is to hit 25-30% ROC. Okay, so that's what our ultimate objective is. That for next 2-3 years we continue to grow at 25-30% CAGR, volume, revenue, EBITDA, CAGR, and PAT, and hit 25-30% ROC with all the investments which right now are going into the business.
So Abhinav, I mean, just as a business, I understand the point that given the kind of white spaces you may say, or the geographical patches that you needed to cover, given you were not focused, as a company, it makes all sense to look at making it a national player. But in the overall kind of chase for doing all that, if I look at the profits have remained stagnant for the past 3 years, and that's where, as an investor, things look a bit difficult because stock price doesn't move. So all past is okay, but as you said, that the endeavor is to grow at 25% on all levels, still PAT. But given the depreciation or fixed cost that will come upfront, even now, given the expansion phase is still on, how do you see the overall profit delivery going ahead? Because now we are at that 10% margin base that we talked about. We might be at a higher level of say 13-14% 2 years back. Now that correction has happened. Now, do you really think that I wouldn't have done the numbers in that detail right now, but according to your expectations, is FY25, 26, 27 going to be a bit more linear compared to the only top line delivery and non-profit growth that we've seen for the past 2-3 years?
So see, I mean, I'll put it in this way. If you look at my existing business, right, it generated 100 crore EBITDA, okay, for FY24. Now there are 3 new engines what we have plugged in. One is Kisan, which is going to generate 800-900 crore revenue with 100 crore EBITDA in next 3 years, right? So this is engine 1, where we have around 55% controlling stake. Then the second engine is these 2 new super value-added products, which is OPVC pipes and window profile, right? This investment of around 150 to 200 crores in next 2 years. These 2 businesses, these 2 new products will generate around 100 crore EBITDA put together. Okay, so 100 plus 100, 200, and then my existing business 100 will grow at like say 10-15% year on year, plus the Varanasi plant, which will add to it, right? Around 40-50 crore EBITDA will come from there. So if you see, I have, I mean, as a management, we have formulated the strategy to take this EBITDA from 100 crores to 400 crores at a group level, out of which Kisan I may own 55 crores of 100 crores, right? So from 100 to 350 crore kind of EBITDA number in next 3-4 years is what we have taken the direction, right? And we have already started putting investments there, right? Around 150 crore we put last year, 200 crore will come this year, right? And 100 crore next year. So yes, I mean, there will be some mismatch, right? Because of fixed cost which come upfront, okay, high depreciation, etc. But one thing I would like to highlight is that we have ensured that my profitability doesn't get hit because of high interest cost. So we are not borrowing to fund this capex, right? This is all from equity infusion or the operating cash flow, right? And with the working capital rationalization, what we have been able to achieve in FY24, sustaining that, I mean, even like, you know, despite this capex, we may have surplus cash on the books, right? So the point is, yes, I mean, taking EBITDA from 100 to 400, right, in 3 to 4 years timeline, it will have its fixed cost upfront, right, the high depreciation cost. But yes, I mean, the target seems very, very clear and achievable. Okay, and I would say that last 2 years have been like pretty bad for the industry. Like we did PAT of 49 crores in FY22, right? 23 was washed out because of inventory write-downs for the industry, right? And FY24 again, I mean, because at that year we were doing margins of 13-14%, but now we are at margin of 10%. So I guess from FY24 we have seen the worst, right? In terms of every quarter you will see, like, you know, new line getting added, new product getting added, Kisan contributing to my numbers. So revenue by 100% will increase quarter on quarter now onwards, right? And in no quarter I can go below 10% EBITDA margin, right? So I would say that FY24 has seen the base in terms of the margins and the profitability, okay? And now next 2-3 years, as we grow 25-30% revenue CAGR, it will definitely translate into a superior earnings growth. But yes, I mean, it may not match for next few quarters, right? But the vision, the target is very, very clear.
Okay. If I may continue this one, the only point I'm trying to make is that theoretically the entire plan looks to be pretty good. Problem is that most of the players in your industry are pretty aggressive, and as you said that margin compromise takes place because you have your volume growth targets in mind. So I mean, should we take it as a certain that this 10% EBITDA margin wouldn't see a downside in the near term, plus the volatility in the raw material cost in the product segment that you are? I mean, keeping that in mind, is that 10% would be a sacrosanct margin that one should look at?
Definitely yes, and let me tell you one thing, that once we do 3,000 crore top line, no, margin by default will come at 15%. That's what that's how the businesses generate margin. Okay, right now at 1,000 crore I'm at 10%. Even if I do the same pricing, but because of my strength in sourcing raw materials, because of my operating leverage, because of my utilization levels for my mills, right, 3,000 crore on same infrastructure, right, will give me superior margins. So what we know is that you generate revenue and margins will come on their own.
Okay. And in Kisan, basically 55% stake that we have. So what is the plan? Because I would suggest that over a period of time you would like to take full control probably. So if you could elaborate on that, how the mapping of this overall plan is, it will be helpful to us.
So right now the focus is to bring that business back on track, right, and generate 800-900 crore kind of top line with 11-12% EBITDA margins, right. So idea is to do that first, right, because we have held on to the existing management, okay. So we are supporting them to achieve these numbers. Let's see how the performance comes in the next 2-3 years, and then we'll devise the plan to what to do further.
Any ESOPs and all in this to this management in the Apollo Pipes?
So Apollo Pipes and Kisan, yes, I mean as a group we are always pro ESOPs, so we are working towards it.
Okay, Abhinav, we'll catch one-to-one basically to discuss in detail. Thank you so much for your replies.
Thank you so much.
Thank you. We have the next question from the line of Utkarsh Nopani from Bob Caps. Please go ahead.
Yeah, hi, good morning, sir. First, I need few data points. So there is a difference between the standalone and consolidated revenue of 10 crore because of consolidation of Kisan Molding. So can you please provide the standalone and consolidated sales volume data separately for March quarter? And what is the agri and non-agri pipe sales volume mix for Kisan and Apollo Pipe separately for FY24? And what is the share of B2B and retail sales mix for us in FY24?
So I guess you ended up asking too many questions. We couldn't note down what about it. But Arunji, let's go one by one. So how many days of consolidation is there?
Almost 6 days of consolidation. So between as far as the numbers goes, so there is a 10 crore of top line addition and around 38 lakhs of bottom line addition in the console results. So since it is a year-end event, so
that's okay. So 7 days of consolidation. Any clarification, further clarification on that?
Yes, sir. So 20,550 is the consolidated volume or the standalone sales volume?
Standalone sales volume for Apollo is around 977.1 CR.
Sir, I'm asking for volume, sir.
Volume is 80,440 for standalone.
And what would be the console volume?
81,235.
Okay. And sir, what is the agri and non-agri pipe sales volume mix for Kisan and Apollo Pipe for FY24?
This is the operator. Can the management hear us?
So for Apollo Pipes, I have told earlier as well, 55 is non-agri, 45 is agri. And for Kisan, it would be 30% building material and 70% agri.
Okay. And sir, what would be the share of B2B and retail sales mix for Apollo Pipe in FY24?
So we are always 10% B2B. That's what we are maintaining. And you want to know for Kisan also?
Yeah, that would be helpful, sir.
Kisan is also same 15-20% B2B.
Okay. So now my next question is like our gross margin has fallen down to multi-quarter low level in this March quarter. And if our project sales got impacted, then why our gross margin has been impacted so sharply by 280 basis on a quarter-on-quarter basis? And what would be the gross margin outlook for Kisan and Apollo Pipe for FY25?
So if you see that my raw material margin or gross margin is around 32,000 rupees a ton, okay, so there are like 2-3 things, right? Project sales, when we say that they are down, right, it's not that project sales which were earlier, they were of low margin. We said that the new projects, the new orders were coming at low margins. That's why we were not taking those orders. Okay, so whatever work we take, we ensure that these are high margin, right? We never take any order which are like low margin orders. So whatever mix we had earlier, they were for better margin, high margin orders, right? But now we are going slow on those orders because we are not getting the desired margins, because you have to invest your working capital here. So to get the desired ROC, you need to have a better margin than what you get in trade, right? My trade is like low working capital cycle business. Over there, I can go for say 9% margin. But for project business, which carries a risk, so I need to ensure that they are at 12-13% margin.
Okay, so what would be the gross margin outlook for Kisan and Apollo Pipe separately for FY25?
So see, I mean, the target for both the businesses we said is 10% EBITDA margin, right? Kisan also we are saying 10-11%. Apollo right now is 10-11%, and it will maintain that. So the gross margin will also be kind of same. We'll have to see Kisan's cost structure, but we look this business as at the EBITDA level. So you can assume that both businesses will generate 10-11% EBITDA margin.
Okay, and sir, like earlier we planned to reduce the share of agri pipe sales mix for us. So whether the acquisition of Kisan Molding is not likely to derail our earlier plan of reducing agri pipe mix going forward, and would also dilute our margin profile as we are targeting only 10% EBITDA margin for Kisan Molding by FY27 compared to our historical standalone EBITDA margin of 12%.
Okay, so there are two things. One is that when you say that the sales for non-agri will come down, it is as a mix, right? Because my building material portfolio will grow faster than the agri portfolio. So the mix will keep on improving towards the building material side. But India being the agrarian structure, right? So there is always a good demand for agriculture pipes, right? And the industry itself is 40-50% agriculture based, right? So as a segment, we will always keep on selling our products in that category. That is one part of it. Second, Kisan right now is 70% agri, not because they are lines or they don't have products to sell in the building material space, because they didn't have money to spend on the brand to go aggressive in the building material space. So they were selling agri pipes, which is like more easy to sell. Okay, so now that they have the relevant working capital in place, they will be able to spend on brand. So they will expand the portfolio, or they will increase the sales more towards the building material side of it. So Kisan also on 1,000 crores, we will expect them to be like, if not 50, at least 45% non-agri and 55% agri. And Apollo on standalone basis will be 70% building material and 30% agri in next 3 years when we achieve this 3,000 crore top line.
Okay. And sir, on the branding part, whether we are thinking of continuing with the Kisan brand for Kisan Molding or plan to consolidate this brand to Apollo Pipe?
So right now, we believe that Kisan brand is strong enough to drive the targets what we have set for the next 3 years.
Okay. And sir, lastly, after the acquisition of majority control of Kisan Molding, whether there is any regulatory requirement to come out with an open offer for acquisition of another 25% stake in Kisan?
No.
Okay. Thanks a lot, sir.
Thank you. We have the next question from the line of Udit from Yes Securities. Please go ahead.
Yeah. Hi, sir. Thank you for the opportunity. So firstly, on the standalone numbers for the volume that you mentioned, so the guidance that you all are maintaining is 25% CAGR. So will that be excluding Kisan or including the Kisan volumes that you are aiming of 35,000 and 50,000 respectively for next year?
No, so 22-23% is without Kisan on standalone basis, and 30% will be with Kisan.
Okay, so going ahead, the 25% volume CAGR on the base of 80,500 odd standalone number. So that is a 25% growth on that number, or even you include the Kisan numbers that you are expecting?
No, say it again, please.
So on FY24 standalone exit run rate of the volume and your guidance of 25% volume growth, so should we build in 25% on the standalone or including Kisan numbers?
Without Kisan, 25%.
And 35,000 tons and 50,000 that you are expecting in next 2 years for Kisan will be something add-on, correct?
That's right. That's right. So we are not changing our guidance, right? Before Kisan, we said that as a company, we want to continue to grow at 25% CAGR. So we continue to do that.
Right. So with this enhanced capacity and of course 55-54% contribution from Kisan's overall performance will be an additional boost. That's the correct understanding, right?
Definitely, yes.
Understood. And considering that Kisan, you will continue with that brand name, so will that be the case also for the building material side? Because there Apollo holds a better brand. So will that SKUs be in Apollo brand? Is that the plan also?
So that strategy is being formulated as we speak, right? We are working on a few options, right? We're talking to our clients, we're taking feedback from them. So I guess in next 6 months we'll be in better position to come out with the definitive strategy how to brand the building material space for the Western markets.
Got it. And in terms of number of dealers, if you could split how much did we exit for Apollo in FY24 and how much does Kisan have and what is the target for 25? What will be the net addition that you would like to see?
So Apollo's exit run rate will be around 700-750, okay, and Kisan should be around 200.
So 900, 950 odd, and what would be the plan to add dealers in 25, 26?
See, it's a continuous process, right? Kisan obviously will have to add much more, right? Maybe they'll have to increase number of dealers by 50%, right? And as far as Apollo is concerned, we are going aggressive in the southern markets, okay, and eastern markets with Varanasi will have to add a lot of new dealers. So I guess, we could be around 800 at Apollo pipe level and 300 at Kisan level.
That's great. Thank you and all the best.
Thank you. We have the next question on the line of Jatin Chawla from RTL Investments. Please go ahead.
Yeah, hi. Thanks for giving me the opportunity. So my question is on this new segment that you're planning to enter, the PVC door and window profile. If you could just talk about, broadly, like the PVC pipes, is there a plan to, kind of shift from one segment to another, or what is the market size today for this product and what sort of share are you kind of targeting?
So see, there is no market size mapping which has been done for UPVC windows or doors, okay, but what we know is that there is an emerging trend in the construction sector, whether it is private construction or government-led housing construction, okay, the developers, the contractors, the architects, they are going after the alternative window door profiles over wooden structures which are available today, right? UPVC, of course, finishing wise, cost wise, and aesthetics wise, right? It offers a better proposition compared to wooden structures in many cases, right? So there is like this emerging market which is coming up, right? And Apollo being a strong brand in the construction material segment, so we thought that it's a good strategy to get into this product segment where right now there are limited number of players, right? And we know the market leader who started this business a few years back has reached to a very handsome scale. So there is a big opportunity which we see going forward in this segment, and we took feedback from a lot of contractors, a lot of architects, a lot of developers before we took this call to get into this segment, and we are also appointing a dedicated team for this business.
And the selling and distribution would be done with the same set of dealers, or you would have to appoint a different distribution network for this?
No, it's a separate channel which will get built.
Okay. So, given that a separate channel has to be created and it is a new product, if I work back the numbers that you were kind of giving for, the two new products that you are targeting 100 crores EBITDA in 3 years, and for PVCO pipes, 120 crore of revenue and 25% EBITDA. So let's say 25-30 crores EBITDA there. It seems for this product you're targeting 60-70 crores of EBITDA, which seems a little bit aggressive. If you could just say in terms of what revenue and margins are you expecting in 3 years to get, on whether this understanding of 60-70 crore EBITDA over the next 3 years is right.
So OPVC, if you see, I mean, what Arunji said was the number which he gave was for FY26, right? That's like 2 years. In 3 years, OPVC will be generating much more revenue than that number. Okay, so what I can say is that out of this 100 crore EBITDA from these two products, 60 crore could come from OPVC and 40 crore could come from window profile, which we believe is not an aggressive number at all.
And this is also a higher margin product like OPVC, 20% plus?
No, not as high as OPVC.
Got it. And so for the next 3 years on the core standalone Apollo Pipes business, you said that you're looking to maintain margins at 10%. Or is there a plan to get back to the earlier 12-13% margins after that, or do you plan to kind of run the company and focus only on volumes and maintain margins at this 10% only?
Sir, वो 3,000 crore पे अपने आप आ जाएगा 12-13%.
Got it. Okay. Thanks.
Thank you. We have the next question from the line of Piyush Khandelwal from Bank of India. Please go ahead.
Yeah, hi, thanks. So just, correlating or especially last quarter commentary on volume growth and this quarter execution. Last quarter said that the volume growth was low because there was low demand, there were other things. This quarter, you're saying about the project, and in the press release also mentioned about channel destocking due to elections. But firstly, on the project side, if I look at your orders are already in hand, let's say at least 3-4 months earlier than your execution. And in last quarter, you said that you're confident of growing at least 25-30% of the volume growth, and you'll surpass the earlier Q4, the highest volume growth that you've done. So, why is this so much of, dichotomy in your commentary and execution? And this, when I correlate with other players, I understand about the project side, but if I look at the other, which are the plumbing focused players, where the project side is not that much, they are also reporting a very good numbers. So, is it really the project business which is hitting, or is it the higher competitive intensity which is getting into the picture? Because if that is the case, that will not go away in 1 or 2 quarters. It will continue at least for next couple of quarters.
So Piyush, we said it very categorically that second half of FY24 has been soft for us. Okay, Q3 demand was weak in the industry, right, because of weak Diwali, etc., right, which impacted the sales. Now in Q4, we were highly optimistic that we will cover up the sales because normally what happens is that these government projects, right, normally there is a lot of execution which takes place for the March quarter, right? Government contractors, they try to finish as much as they can during the end of the fiscal year. So when we were having when we were having this call, right, in January, so we thought that there will be good orders which will come in Feb, March, okay, which we will secure and we will do the execution, and whatever revenue loss we did it in Q3, that we will be able to cover up for Q4. orders were there, right? But the problem is that the competitive intensity was more in government side than trade side. See, trade side, Apollo is a strong brand, so we are there to compete against any other player. I'm not scared. Okay, but in government, I don't want, because of my commitment towards capex, right, and my own strategy to rationalize my working capital, I do not want to get my WC stuck, right, to get stuck for government projects, right. So we took a conscious call not to go aggressive during late Feb, early March, right, to take orders and secure. Because there are contractors who want to finish work, right? They were in the market, giving orders left, right, center, right? But then the conditions which we did not like, and we said, okay, let's go. Let it go.
All right, but if I look at, I mean, especially this infra spending or the execution, especially this will also be challenging in the first quarter, because first quarter is almost election, all the first 2 months. So that 25% guidance that are giving for the Apollo standalone, does that also at risk just because of this, and maybe 15-20% is a more realistic expectation?
Sir, Q1 का बताना थोड़ा tough होगा, right?
That's what I'm asking. Is 15-20% is a more realistic expectation for us?
See, we did 22% for FY24, even with such a bad Q3 and Q4. Right. So yes, when we are saying 25% for full year, that is factoring in that Q1 is going to be soft because of election, etc. Right. But we know our product pipeline, we know our dealer channel sitting light on our stock. Right. We know when to gain momentum sales. Right. Then OPVC will start. Right. For us. Window profile also will start towards the end of the year. Some sales will come there, right? My Varanasi plant, right? So we have a lot of levers, Piyush. We have a lot of levers to deliver this 25% CAGR.
Just one data point out of this 80,000 tons that you've done in the standalone business. What will be this project contribution that you're talking about where you've not participated? Roughly.
So for the full year could be 10%, but for second half it will be even lower. For Q4 it will be like even lower.
And this had grown at what rate for a full year? This 10%?
Like full year to decline है.
10% लगभग 5-10% decline होगा?
हाँ, yes.
All right. Another question is on this Kisan acquisition which you've done. So the brand name of Kisan will continue? You will change the brand name? How does that going to work?
So abhi to for next 1-2 years we think Kisan is strong enough to drive sales to 800-900 crores, Piyush. अभी लग रहा है अगर बीच में लगेगा कि कुछ strategy change करना है, so we'll see, we'll evaluate, right? But अभी तो लग रहा है Kisan has that strength to drive the sales.
All right. Got it. Thanks.
Thank you. We have the next question from the line of Keshav Lahoti from HDFC Securities. Please go ahead.
Hello. Hi. Thank you for the opportunity. So I want to get a color more on Q4 and how's the Q1 going, because normally our understanding is Q4 the demand was strong, and even if the project sales, which is just 10% of your revenue, was weak, still we see subpar 10% volume growth in Q4. So it has to do something more than project sales also. Hello.
For Q4, the project contribution was less than 10%. It was in low single digits.
Yeah, so normally you grow by 25%. This quarter is like 10, so there is a 15% growth mismatch which has happened in Q4 when the demand was strong. So 5% could be attributed to project, but the remaining 10% has to do something other than project too. And how is the Q1 shaping up?
Do you know what was my contribution in Q4 last year? Right, it was like high double digit.
Okay.
And right, so the project business declined very sharply, right, in Q4. If you're comparing Q4 of FY23 and Q4 of FY24, the project sales, the project revenue declined very sharply. Okay, so what I can tell you is that the trade sales, we grew at a decent number for the Q4, right? And because of my lower project sales contribution, the performance appears low. And as far as the Q1 is concerned, April, it's been like 1.5 months right into the quarter. The run rate is okay. Of course, because of elections, etc., projects as in like even the private projects, things are moving slow, and our channel partners, clients, even they are also cautious, like stocking at high levels because everyone is like, let the election result come and then we see how things move. So I guess after first week of June, the sales momentum will pick significantly.
Got it. And what is the project sales bifurcation between government and private?
And just to add to it, like Uttar Pradesh is having general elections, right, in 7 phases, right? Uttar Pradesh is an important market for us, okay, and the main market for us. So our sales got disrupted like 7 times for this election, right? But it's okay. Like I said, we'll cover it up. From after first week of June. Sorry, go ahead.
Okay. So I was asking, what is the project sales bifurcation between private and government?
Private projects, we don't do directly. Our dealers sell to all the developers, right? So I don't know what you mean by government and private. Okay. Private as in selling to Oberoi, DLF, etc.
Yeah, perfect.
Yeah, so that's our dealers who sell.
Okay, got it. So this 10% is entirely government. What do you say, 10%?
Of course, yes.
Got it. What has been your ad spend for this year, and what are your plans going forward?
Ad spends remain around 1.5 quarter to 2% of the top line.
And will it remain at same level, or is it going to increase?
There will be slight increase in FY25 to 2.25%.
Got it. Last question from my side. What was the net dealer addition for this year?
Around 50, we would have added new dealers. 57 to be precise.
Okay. Thank you. That's it from my side.
Thank you. We have the next question from the line of Kunal from Kitara Capital. Please go ahead.
Am I audible?
Kunal, your audio is not very clear. Please go off the handset. Please go
audible now? Am I audible now?
It's sounding muffled.
Audible now?
Yes, this is loud and clear. Please go ahead.
I just wanted to ask the asset turnover ratio in ductile iron pipe and window profiling business. How much in each individually are we putting out of 150 to 200 crores, and how much revenue are we aiming in both, and the EBITDA margins in both the business? Hello.
So Kunal, this is slightly sensitive data, okay, because these are new products. But broad-based, like I said, 200 crore is what going to get invested. So 60-70% out of this in OPVC and rest in window profiles. Okay, in OPVC the asset turn is 1.5 times, right? And in window profile the asset turn is 5 times.
Okay. And EBITDA margins?
OPVC, Arunji clarified around 25%, and window profile, I mean, based on all the expenses of business development and branding, we should touch like low double digit.
Okay, thank you so much. Thank you so much.
That was the last question. I would now like to hand it over to the management for closing comments.
On behalf of the management, I thank you all for the patient hearing. We hope we were able to explain your concerns
You may contact for any other further clarifications required. Thank you once again for joining the call.
Thank you. On behalf of Apollo Pipes Limited, that concludes this conference. Thank you for joining us, and you may now disconnect your lines.